In this video, we're going to talk about different types of orders that you can place. So let's jump into it. The first order we're going to talk about is something known as the market order. If you were using a market order, this would give you the fill based on the current market price. And if you remember in the previous video, we talked about the bid and ask. And so the larger the spread is, the worse it is. I'm going to give you an example of what you shouldn't do. Here we're looking at a security known as HireCar. It's just a company which not a fan of at all, and so don't actually do this, but you can take a look at some of these bid-ask spreads. First of all, it's trading at less than $1, so you shouldn't be trading this whatsoever anyways, but just want to give you an example of the bid-ask spreads. So if you want to sell a $5 put, the highest someone is willing to pay for that is $3.60. If you want to buy the $5 put, the lowest someone's willing to sell it to you is $5.40. You see how wide the spread is? So these are things you definitely want to avoid. If you're using a market order, you're going to get filled at this $5.40 immediately if you're buying. And if you're selling, you'd get filled at this $3.60 immediately if you're selling. Again, here's an example of what not to do. Don't trade these securities which are extremely illiquid, which barely have any expirations, and the spreads are super large. Also, the stock's trading at below $1. You should never do this. Next order we're going to look at is something known as a limit order. Really quick recap. Market orders, don't use these. Limit order, you should use these. All right, so what is a limit order? Basically, the trade only executes at the price you want it to. So for example, if a security right now is trading at $1, but you only want to sell the option at the moment it goes to $1.50, don't use a market order, you'd use a limit order, and it would only execute only if the option price comes to $1.50. If the option price does not go to $1.50, that means the trade won't execute and you won't be short this contract. So as a quick recap, there's market orders and limit orders. Even though I said you shouldn't use market orders, I think that's accurate for 95% of the time. The only time you should use a market order is if you have very high trade urgency, as in you absolutely need to get that order filled. If you're not trying to trade urgently, I think limit orders are the best way to go. Great, I'll see you in the next video.